Welcome back to the Deep Dive. We're the place you come to when you need complex information finance, tech, regulation broken down into the absolute essentials. Today, we're diving deep into XRP. Now, this is an asset that's seen its fair share of drama, maybe more than most in the crypto space. A lot of people, maybe you included, still see it mostly as, a speculative altcoin. Price goes up, price goes down, lots of noise. But we're asking a different question today. What if the real lasting value of XRP isn't about the price chart at all? What if it's actually rooted much deeper in its structural utility, like as actual financial plumbing?
That's exactly the angle. We're pushing past the hype, the day-to-day market swings, and looking at the mechanics underneath. We've dug into a whole range of sources, bank partnerships, reports on institutional treasuries, legal documents, and we've boiled it down to 5 key forces. These are sort of the pillars holding up XRP's potential value proposition, separating what's fundamental from what's just, market sentiment. And understanding these 5 drivers is really vital for you, the learner. Why? Because it helps you tell the difference between, say, temporary speculation and genuine structural value. That's key for making informed decisions here.
Right, so we're covering the whole picture. Global payments, big institutions getting involved, the tech itself evolving, and maybe most importantly, the big legal wins that have really shaped its path recently.
And of course, we have to start with the standard disclaimer. This is purely an analysis of the information we've gathered. It's about context and understanding. Under no circumstances is this financial advice or investment advice. Always, always do your own homework, especially with assets like this that face ongoing regulatory shifts and pretty stiff competition.
Okay, absolutely clear. Let's get into the structural argument then. And driver number one seems like the logical starting point. Cross-border payments, remittance efficiency.
Yeah, this is really the foundation. The whole initial pitch for XRP was about using it as a bridge currency to fundamentally change how money moves across borders. To really get why that's a big deal, you got to look at how banks used to do it and often still do.
Ah, the old Nostro Vostro system, right? Painful stuff.
Exactly. So Bank A in one country wants to send money to Bank B in another. Traditionally, Bank A had to keep money parked in an account at Bank B, in Bank B's local currency, pre-funded. Banks have literally billions tied up globally in these pre-funded accounts, just sitting there, waiting. It's inefficient, it's costly capital, it carries risk, and it makes settlements slow.
Yeah, that capital is just locked. Dead money, basically. Expensive, slow. Banks hate it.
And that's the friction XRP aims to cut through. The core idea is using the asset to zap value across instantly, so you don't need that pre-funded capital sitting idle. Instead of funds being locked for days, the process becomes, well, almost instant. Convert fiat to XRP. XRP crosses the ledger in, under 5 seconds? Then convert back to fiat at the other end. The speed and, crucially, eliminating that pre-funding need, that's the structural value proposition right there.
And this isn't just theory anymore, is it? The sources show this is actually happening in specific corridors.
Oh yeah, definitely. We see a lot of activity in Asia Pacific. SBI Remit in Japan, for instance, they're actively using XRP for transfers to places like the Philippines, Vietnam, Indonesia. These are massive remittance markets, often with tight margins, where speed really matters. People are waiting for that money.
And it seems like that network is growing too. Tranglo in Southeast Asia using Ripple, Pipel connecting Africa and Asia. These aren't small players.
Right. Triangle is a big payments hub. Pipel is tackling those really tough, high-cost corridors between Africa and Asia using XRP, partly to manage volatility risk, too. And then there's the Brazil example, Ripple and Banco Rendimento, using XRP specifically as the settlement bridge for business payments. This isn't about sending $50 home. This is institutional flow. The sources suggest potential cost savings there could be huge, like 40% to 70% compared to the old ways. That's real money for a bank's bottom line.
Okay, let's talk numbers then. Sub 5-second settlement for XRP. And the fee is tiny, like a fraction of a cent.
Basically negligible.
Yeah.
Fraction of a cent.
Compare that to Swift. Days, potentially. Multiple banks taking a cut along the way, fees stacking up.
It's a night and day difference. For certain corridors, especially those high-friction ones, it makes the old system look incredibly clunky and expensive. It can make previously unprofitable routes viable.
But, okay, let me push back a bit here. The big elephant in the room for crypto is volatility, right? Why would a risk-averse bank use XRP even for 5 seconds when they could use something like USDC, a stablecoin pegged to the dollar? Doesn't that 5-second volatility risk wipe out the benefit?
That's the million-dollar question, isn't it? And it gets to how XRP is used in these flows. Often, it's strongest in corridors, where maybe USD stablecoin liquidity isn't as deep, or the regulations around stablecoins are still fuzzy. And the key is the speed. Because the XRP part takes just 3 to 5 seconds, the exposure to a price swing is minimal, almost zero in practical terms. The bank isn't holding XRP for any meaningful time. It's purely a pass-through, an instant transmission rail. The savings on freeing up that pre-funded capital, according to the thesis, massively outweigh that tiny sliver of volatility risk over a few seconds.
Got it. So it's like an instantaneous swap, not an investment hold. Okay, that makes sense for the banks. But for real structural value, you need more than just B2B, right?
Which brings us to driver number 2, loyalty, travel, and getting consumers involved.
Right. This is about broadening the base, moving XRP from just being this back-end tool for banks to something people actually, interact with. The idea is to embed it into things like loyalty points, travel rewards, making it genuinely useful in everyday life, not just something you trade on in exchange. Yeah, the moment you can buy a coffee or book a flight with it, it feels different, more real.
Exactly. It potentially brings millions of users into the ecosystem, not just a few hundred banks. And the big case study here, the one that jumps out from the sources, is Weebus and WeTour. I mean, they set up a $300 million XRP treasury. That's a huge number, specifically to back travel vouchers, loyalty programs, settle services like airport transfers, premium rides.
$300 million just for that. That's a massive bet on using XRP operationally.
It really is. And the scale of potential users is huge, too. The sources mentioned something like over 60 million loyalty members could eventually interact with these XRP-backed services. Think about it. Instead of points that expire or are hard to use, you get a tokenized voucher. Maybe it's more liquid, easier to trade or combine. It makes the whole loyalty concept potentially much more valuable to the user. And that drives demand for the underlying tech.
So it's not just about spending, but earning too.
Yeah, absolutely. Back in Japan, SBI VC trade users can earn XRP through specific loyalty campaigns. So you earn it, then maybe you spend it on travel through something like Weebus. It creates this kind of closed loop driving activity.
I remember hearing about the XRP tip bot ages ago in the Netherlands. It's gone now, but it showed micropayments were possible, right?
That was an early glimpse, yeah. Showed the tech could handle tiny instant payments because the fees are so low. You couldn't do that with traditional banking. That basic capability is what makes these big loyalty schemes technically feasible today.
Okay, so for you, the learner, why does a travel voucher matter? Because if millions of people are using XRP-linked services via Weebus, that creates real non-speculative demand. Weebus needs the infrastructure to work. That potentially puts a floor under things, or
Right.
more stability than just trading whims.
Precisely. It ties retail demand to institutional need. Those managing the loyalty programs need XRP or related tokens to function, which leads us straight into the next pillar, the institutions themselves.
Right. Driver number 3, institutional adoption and treasury use. This is where the big money and arguably the big credibility comes in. When major financial players start using XRP not just for trading, but operationally.
Yeah, this is huge for validation. If a regulated institution decides to hold XRP on its balance sheet, use it for liquidity, for settlement, as a reserve, that's different. That's treating it like long-term infrastructure. It creates what you might call sticky demand that isn't just going to vanish overnight based on market sentiment.
And the prime example here has to be SBI Holdings in Japan, right? Their involvement seems way beyond just experimenting.
Oh, absolutely. SBI's strategy is deeply integrated. They view XRP as core plumbing. They hold a very large XRP reserve, and they use it across their businesses. SBI Remit for payments, SBI VC Trade for the consumer exchange side. And the scale mentioned in the sources is, well, it's staggering. Around 1.6 trillion yen worth of XRP and related crypto assets reported on their books at one point.
1.6 trillion yen. How does that compare? I mean, what does that number signify structurally?
Well, according to the reports, at certain times, the value of those crypto holdings actually exceeded the entire market capitalization of SBI Holdings itself. Think about that. A major publicly listed financial group holding so much of an external digital asset that it outweighs their own company value? That's unprecedented institutional conviction. It's basically saying, this is part of our fundamental capital structure now. It's not just diversification, it's infrastructure.
That sends a massive signal, doesn't it, to other banks, to regulators globally? Like, we believe this is stable enough, compliant enough, crucial enough to bet our business on.
Exactly. And while SBI is the deepest dive, others have been testing the waters. Santander in Europe ran pilots using XRP for settlement with their OnePay FX. And there have been persistent reports about major players like Bank of America doing exploratory work with Ripple and XRP, looking into settlement efficiencies. Just dedicating R&D time from institutions like that validates the potential cost savings we talked about earlier.
And even the Weebus example ties back here, right? That $300 million treasury isn't managed by some random person. It's an institutional fund ensuring the whole consumer loyalty system works.
Yes, it all layers together. Institutional capital, managing the systems that deliver retail utility. So the takeaway for you is, when serious institutions start treating this like essential long-term plumbing, not just a speculative chip, it fundamentally changes the narrative. It starts to look more like infrastructure, less like just another altcoin.
Okay, but all this utility, institutional buy-in, it needs a solid foundation. Which brings us to driver number 4, the technology itself. The XRP ledger, the XRPL. If the tech can't scale or isn't reliable, none of the rest matters.
Absolutely fundamental. The tech has to work, has to be robust, and the XRPL was built from the ground up specifically for payments and financial transactions, not like, say, general smart contracts initially. We've mentioned the speed, 3 to 5 seconds, and the super low cost, which is crucial for those micropayments in loyalty or remittances.
Speed's good, low cost is good, but lots of blockchains are fast now. What gives institutions like SBI the confidence in this specific tech?
A lot of it comes down to the consensus mechanism.
Yeah.
It doesn't use proof of work like Bitcoin, which is energy intensive. It uses a consensus protocol involving a list of known, trusted validators, the unique node list, or UNL. There are over 150 of these independent validators. Their identities are generally known. Their reliability is key. This model allows for very fast confirmation, high throughput, and much lower energy use, while still being decentralized enough and, crucially, auditable in a way enterprises need.
So it's sort of a more controlled decentralization, geared for speed and reliability needed by finance without Bitcoin's energy footprint or maybe some of the congestion seen on other chains.
That's a good way to put it. That's the core technical pitch. But importantly, the ledger isn't static. It's evolving. And that's vital to stay competitive.
Right, the upgrades. You mentioned programmability. Let's get specific. XLS20, XLS70, 80. What do these actually do for businesses?
Okay, XLS20 is a big one. It brought native NFT support right onto the XRPL. Now, why does that matter for, say, Weebus? Their loyalty points, their travel vouchers, they can now be issued as unique, non-fungible tokens directly on the ledger. This means they have unique IDs, you can program rules into them, like expiry dates, and they're way more transparent and potentially transferable than just numbers in a database.
Ah, so it turns that loyalty voucher from just an entry in their system into an actual digital object on the blockchain, potentially more flexible, maybe even tradable.
Exactly. It opens up possibilities. Then you have things like XLS70 and XLS80. These are really aimed at the regulated players, the banks, maybe even governments. They introduce features for digital credentials and what's called permissioned domain control. Basically, it allows an institution to issue assets but still control who can hold them or transact with them, maybe based on KYC status or other rules.
Okay, so that sounds like building the tools needed for compliance. If a bank wants to issue something on the ledger but needs to control who uses it, these amendments help them do that.
Precisely. They're building the on-ramps for regulated finance, trying to blend the efficiency of blockchain with the controls that institutions absolutely require. So beyond just payments, the XRPL is aiming to support tokenized assets, maybe pilots for CBDCs, other financial instruments. The tech roadmap is clearly pointed towards enabling compliant high-speed finance.
Which is the perfect segue to our 5th, and you could argue the most critical driver recently, regulatory clarity and the network effects that follow. Because the best tech in the world doesn't mean much if regulators block it at the door.
Couldn't agree more. This is the great enabler. For years, the big cloud hanging over XRP, especially in the US, was the SEC lawsuit. That legal uncertainty was arguably the single biggest brake on wider institutional adoption globally. All that potential structural value we've talked about, it was basically locked up until the legal risks started to clear.
Okay, let's spend a moment on the mechanics of that legal ruling because it's crucial. July 2023, Judge Annalisa Torres. Just saying XRP is not a security isn't the full picture, right? What was the specific legal finding?
Right, the nuance is key. Judge Torres applied the Howey test, the standard U.S. test for what constitutes an investment contract, a security. And she didn't rule on XRP, the asset, in isolation. She looked at the sales. She made a critical distinction. One, direct sales from Ripple to institutions. She found these often met the Howey test because the buyers expected profit based on Ripple's efforts. So those specific sales were deemed unregistered securities offerings. But two, sales on public exchanges to retail buyers. Here, she ruled differently. The anonymous buyer on an exchange didn't have that same direct relationship or expectation based on Ripple's specific actions. So those sales did not meet the Howey test.
Wow, okay. So the same token could be part of a securities transaction in one context, direct institutional sale, but not a security when traded between anonymous users on an exchange. That's the distinction that led exchanges like Coinbase relist it, right?
Exactly. It de-risked the secondary market trading for exchanges and retail users in the U.S. It was a landmark ruling because it offered a potential framework for how other digital assets might be viewed, focusing on the context of the sale, not just the asset itself.
And then the final chapter, legally speaking, came later. The sources mention August 2025, SEC dropping appeals, Ripple paying a penalty.
Yes, that brought finality. The SEC decided not to pursue appeals on the core ruling about secondary market sales, and Ripple settled the institutional sales part with a $125 million penalty. That removed the last big question mark. For global institutions, especially any U.S.-based ones considering using XRP, that finality was critical. It meant the risk of the whole thing being shut down by U.S. regulators largely evaporated. Legal certainty unlocks institutional capital.
And did we see a tangible effect? Did the network actually grow after that clarity?
The numbers suggest so. By 2025, reports mentioned over 6.6 million active XRP wallets globally, over 6 million accounts created on the ledger itself. And look at a market like Japan, where SBI was already deeply involved and regulation was clearer. SBI's crypto exchanges, SBI VC Trade, and BIT Point Japan saw their user accounts basically double in a year. From around 800,000 in March 2024 to nearly 1.65 million by March 2025. That's a huge jump, likely fueled by that reduced regulatory risk and SBI's own push.
So it's a loop. Regulatory clarity boosts institutional confidence. Institutions drive adoption. Adoption grows the network. A bigger network makes the utility stronger.
Exactly. It becomes this self-reinforcing cycle. More users, more liquidity makes the cross-border payments work better, attracts more partners. It makes it harder for competitors to displace XRP in the niches it's already established, like those specific remittance corridors.
Okay, we've laid out a pretty strong case based on these 5 drivers, but let's bring it back to the listener. What does all this structural stuff actually mean for you tracking this market? How do you translate this into something useful?
Well, for someone looking longer term, the idea is that these drivers, the regulation, the institutions, the real utility, potentially provide a kind of structural support for the asset. It suggests that maybe over time, as usage grows, the wild volatility we associate with pure speculation might lessen somewhat. And that regulatory clarity, especially, could open the taps for more traditional finance money, TradFi capital, to flow in as they need that legal certainty.
And for shorter-term traders, does this analysis change anything?
It suggests maybe shifting focus. Instead of just watching Bitcoin's price or general market sentiment, you'd pay closer attention to news specifically related to these 5 drivers, like a major new bank partnership gets announced, a big brand actually launches an XRP loyalty program using XLS20, a positive regulatory development in Europe. These kinds of events might make XRP move independently of the broader altcoin market because they directly impact its own unique ecosystem and utility story.
Okay, makes sense. But we have to be realistic. XRP isn't operating in a vacuum. The competition is fierce, right?
Oh, absolutely fierce. You've got 2 massive forces, mainly. First, stablecoins, things like USDC, USDT. They already handle enormous volumes on-chain. They're integrated everywhere, and crucially, they solve the volatility problem by being pegged to fiat.
Right.
That's a direct challenge to XRP's bridge currency role. Second, you have central bank digital currencies, CBDCs, on the horizon. Backed by governments, fully regulated, they carry immense trust.
So how does XRP possibly compete? Stablecoins offer stability, CBDCs offer state backing. Where's XRP's edge?
It seems to be focusing on niches where its specific strengths shine. Primarily decentralized liquidity, especially for non-USD currency pairs, where stablecoin options might be fewer or less liquid, and its raw speed and low cost. Stablecoins are still very dollar-heavy, and their regulation isn't uniform globally. CBDCs will likely be quite centralized, maybe slower for certain cross-border hops due to compliance hurdles. So XRP tries to be that super fast, super cheap, neutral bridge asset that's already got regulatory clarity in key markets. It fills a gap, potentially, between fiat, stablecoins, and maybe even CBDCs themselves, acting as the instant settlement layer between them.
So the strategy isn't necessarily to replace everything, but to find its place within the evolving financial system. Coexistence.
I think that's the more realistic path. Focus on those high-volume remittances, the loyalty integration, the instant settlement needs where 3 to 5 seconds and near-zero fees are killer features. If it becomes the go-to plumbing for those specific tasks, Doesn't need to be everything to everyone.
Okay. Now for the reality check. Let's talk risks. What could derail this whole structural narrative?
Number one is probably adoption lag. We hear about big partnerships, pilots. But are people, are businesses actually using it at scale, day in, day out? There's a risk that the real-world transaction volume just doesn't materialize fast enough to support the valuation or the narrative. Hype versus actual boring daily usage.
And regulation. A U.S. picture is clear, but it's a big world.
Exactly. Global regulatory fragmentation. Just because the U.S. ruled one way doesn't mean that EU or major Asian hubs will follow suit. A ban or different classification in a key market could seriously shrink its potential. Regulatory risk hasn't vanished, it's just shifted geographically.
What about the mechanics of the payments themselves?
Liquidity constraints. For that cross-border payment dream to work seamlessly, you need easy, instant conversion from fiat to XRP and back again in both countries. If the on-ramps or off-ramps are weak, or if local exchanges don't have enough XRP liquidity, the whole process slows down, friction creeps back in, and the advantage disappears.
And finally, even with the settlement, there's always that lingering doubt, isn't there? The what if.
Yeah, the tail risk of reversal. The 2025 settlement happened under existing laws. Future legislation in the U.S. or elsewhere could change the game entirely. New laws, political shifts, they could bring back that uncertainty. And if adoption just flatlines despite the legal win, the market might eventually conclude the core business case wasn't strong enough after all.
Okay, so if you, the learner, buy into this structural thesis, or at least want to track it seriously, you need more than just headlines. You need data. What specific metrics should people be watching?
Right, let's get practical. First, basic network usage. Track daily transactions on the XRPL account, the value moving across. Watch the average fees, and critically, look at the growth in new accounts and active addresses. Is the user base actually expanding consistently? Flat growth is a red flag.
And for the core remittance use case?
You need to find evidence of real-world corridor volume. Look for reports, data, even company statements talking about the value being moved via XRP between specific countries, like that Japan-Philippines example. Are the volumes growing? Are more partners actively sending transactions, not just signed up? That validates the on-demand liquidity model.
What about the consumer side, the loyalty programs?
Look for loyalty integration metrics. Are new major brands coming on board, beyond Weebus? And more importantly, are users actually redeeming these XRP-backed points or vouchers? We need to see usage data, redemption volumes, not just signups. Utility means use.
And for the big players?
Keep an eye out for institutional treasury announcements. Are other large non-crypto companies besides SBI publicly stating they're holding XRP for operational reasons as a reserve? Look for mentions in official filings, earnings reports. That's hard, verifiable commitment.
And the tech upgrades we discussed?
Track protocol development, activation, and usage. When those amendments like XLS20 go live, that's step one. Step two is seeing who actually uses them. Are NFTs being minted? Are loyalty programs being built on it? Are banks using the new enterprise features? If the tools are there but gather dust, the tech innovation isn't translating into value.
And always keep content.
Always. Comparative on-chain analysis. Constantly check XRP's transaction volume, its liquidity, against the big stablecoins like USDC and USDT. Is it holding its own in relevant areas, or is it just a drop in the ocean compared to them? That tells you about its real competitive standing.
Right. So if you hear about a huge partnership, but then you check the on-chain data and transaction volume barely budges, that's your signal that maybe the impact isn't immediate or it's still just a plan.
Exactly. Follow the flow.
Okay, this has been a really thorough breakdown. We've seen that XRP's value argument really rests on these 5 structural pillars: the cross-border efficiency, the push into consumer loyalty, getting institutions to use it operationally, the underlying tech evolving, and that huge factor of regulatory clarity.
Yeah, that August 2025 settlement was undeniably a turning point. It shifted the narrative from legal limbo to potential execution. These 5 drivers are essentially the pathway for XRP to try and become genuine financial infrastructure. But, and it's a big but, success depends entirely on seeing those metrics move. The execution has to match the potential.
So for you listening, the advice seems clear. If you're looking at XRP, maybe you view it less like a quick crypto trade and more like a long-term structural bet. Its success hinges on real-world adoption, on compliance, not just market hype.
Look beyond the price ticker. Try to find the actual transaction data, the usage stats. That's where the real story, the structural evidence or lack thereof will be.
All right, let's leave you with a final thought to chew on. We've dissected these 5 drivers: cross-border payments, loyalty and consumer use, institutional adoption, tech features, and regulatory clarity. Considering everything we've discussed, which one of those factors do you think will be the absolute most critical, the most decisive in shaping where XRP goes over the next year or two? Is it the tech finally proving its efficiency, or was the regulatory win the main event, just unlocking inevitable institutional money? Something for you to consider. Thanks for joining us for this deep dive. We'll catch you next time.